The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Wall Street drifts into the close amid trade talk progress and labor market trepidation. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. We're kicking you off to the close right here in the U.S. Headline level, not that much. Some stocks, though, definitely moving big time.
Oh, and one big one we're going to talk about in just a second.
That would be Tesla. Okay, let's take a look at the market here. The S&P is just down by about 0.1%. It tried to make a run for a bull market since that February high, closing high on February, and then the low we saw in April. We rebounded almost 20%, but now we're a little bit back in the red. The dollar is also a little bit weaker, but off the lows of the session. It was around the lows of July 2023, and that 2-year yield, you're seeing some heavy selling. It feels like that's a European story, though, selling in European bonds, selling here in the U.S. on the front end, despite that weak economic data, Romaine.
Yeah, meanwhile, you go back to stocks here and the drag on the S&P, a big one coming from Tesla. It could have been a much different story just a few hours ago with the news of that phone call finally between Donald Trump and Xi Jinping. That provided a big bounce off the intraday bottom for U.S. equities that briefly extended that rally from the April 8th low to 20%. Briefly, that bounce has obviously faded amid the lack of details on progress toward lower tariffs with China or, quite frankly, anyone else. Now, the phone call between those leaders is still encouraging. We should point that out. The first kiki of Trump and Xi since the U.S. president's inauguration back in January. Now, that call, of course, came on the same day as trade data showed the U.S. trade balance narrowed even more than expected, with imports dropping 16% in April from March and exports rising 3%, rising for a fourth consecutive month to a record high. And that actually could be bullish, potentially, for the economy in the short term. But longer term, keep an eye on the labor market. The government tomorrow releases that monthly payroll figure a day after we saw weekly jobless claims unexpectedly rise to the highest since October. Bloomberg Economics expecting a modest gain for the May payrolls that would be softer than April, but not as weak as it would have been if tariffs on China trade hadn't been paused mid-month.
All right, well, my question, Romaine, really is, will good news be good news in the jobs report? This is a great chart that shows the S&P move on jobs days going back throughout the year. And you can see it's mostly been in the green, with the exception of 2 months ago, where we saw that really dramatic sell-off. So if we get kind of something right in the middle of that 125,000 non-farm payroll report, J.P. Morgan says you could see a gain of anywhere from 25 basis points to a full 1 percentage point. It doesn't get really dicey until you get below that 100,000 level. Then J.P. Morgan sees 2 to 3% on the downside. So are we in a good news scenario when it comes to economic data and equities, Romaine?
The market's starting to reposition around that here on this Thursday afternoon. Kristina Hooper joins us in Studio 2. She's the chief market strategist at Man Group. Kristina, great to see you.
Great to be here.
Let's start off with the state of the economy that's kind of in flux right now. We have a big jobs report tomorrow, but we've had a lot of economic data over the past couple of weeks that's kind of painting a really mixed picture. And I'm wondering for investors, do you count on the potential for economic resiliency or some sense of stability? Or do you now start to think about the more worst case scenarios?
Well, certainly I think economic resilience has been the reason that the data has been as good as it has in the face of what I think are pretty strong headwinds. But I do believe as we move forward, we are going to see more and more signs that the economy is deteriorating. We have really two key drivers of that. One is economic policy uncertainty. It might be easy for markets to shrug off all the changes, all the tariff sort of soap opera that goes on. But that is not the case for business owners. Mm-hmm. And we see it in places like the Federal Reserve Beige Book that came out yesterday, where they're talking about uncertainty is having a chilling effect.
When does that show up, though, in the corporate bottom lines? And I know we've seen some companies have reported and we've seen some impact. And I know it's still early. I mean, we talk about an earnings season that kind of occurred before the real bulk of the tariff chaos came to be.
Well, we'll probably start seeing it in business investment. We'll probably start seeing it in lowered hiring plans and lowered hiring. I think ultimately, though, it will show up in earnings, particularly for companies that are retail-based, that are focused on lower-income consumers. You know, one startling thing we heard earlier this week, Dollar General talked about how what they've seen is the biggest shift in consumers in the last 4 years in terms of upmarket coming down to shop there. Not a good sign.
Yeah. I also wonder, though, how fragile sentiment is, in that if we don't get any more bad news, can we have a substantial move higher? Or at this point, do you think we actually need good news, like an inked trade deal with some country other than the UK?
I think we're going to need good news like an inked deal for business owners, for decision makers, and for most consumers. That's not the case for markets. Markets will take anything as a reason to go up. But I think it's different, and that's the heart, that's Main Street. And so we do have to be worried about that.
So what data are you looking at then? I mean, is it small cap earnings? Is it NFIB? Is it just like jobs, but in very particular types of industries? Where are you looking for that hard data?
All of the above, because it can come from anecdotal information in earnings, right? The kinds of things that we're hearing from individual companies are oftentimes the first signs, the first canaries in the coal mine. Then it's followed up with more general data, more compression in earnings, those kinds of things. But that will take a little time. But I would anticipate we'll see some of it show up in second quarter earnings.
So, I mean, with regards to portfolio construction, is this a situation where you start to think about being underweight equities, or is there still a case to say stay overweight, and I'm primarily talking U.S. equities, to stay overweight U.S. equities, maybe you balance that out to some degree with whatever you can pick up in the fixed income market? I mean, what generally is your strategy right now?
I would say maintain equity exposure, but move from the U.S., take some off the top of the U.S. and move to areas like European equities, UK equities, and even Chinese equities.
Even Chinese equities?
Even Chinese
really?
equities. Those are areas where we're seeing more stimulus. Mm-hmm. So if we think about it in terms of positive economic surprise, which then can translate into positive earnings surprise, those are the areas that I would focus on. And I think always having a healthy exposure to alternatives in an environment where we could have high correlation between equities and fixed income.
I'm intrigued by that. I mean, I get the Europe one and UK one. China, though, I mean, isn't there still a great deal of geopolitical risk tied to that, particularly given the relationship between the U.S. and China, which is really no relationship at all right now?
Absolutely, but that means that it's largely priced in. Valuations are very low. So if we see some upside there, I think it could be very, very impactful. Also, keep in mind what we've seen over the course of the last few months is more increasing signs that China is a peer on par with the U.S. in terms of technological innovation in a number of industries, and may actually surprise and exceed the U.S. in terms of some industries. And there's real potential there, especially with valuations so low.
So that wouldn't necessarily be a bet on the Chinese consumer, because the government has had a very difficult time stimulating that part in terms of building and stuff and manufacturing. Like, they've done much better, and that kind of technology and solar panels, et cetera. Is that where you'd be betting then?
I would actually say there is a bet to be made on the Chinese consumer as well. Now, if you think about it from a Chinese consumer's perspective, during the pandemic, I think the general consensus was there wasn't the kind of stimulus. They didn't feel they got the adequate stimulus that other countries gave out at that time. But what we've seen is really, perhaps in preparation for tariff wars, in the last year, we've seen very significant stimulus. I think it's meaningful for consumers.
All right.
Interesting.
All right, Kristina, always great to have you. Kristina Hooper, Chief Market Strategist over at Man Group, kicking us off to the close here on this Thursday afternoon. Biggest decliner right now in the S&P 500 is Tesla, but one of the biggest performers across the tape right now is Circle, the new kid on the block, surging as much as 235% after raising almost $1.1 billion in its IPO. A conversation in just a second with the co-founder and CEO, Jeremy Allaire.
All right, plus all eyes on Lululemon as stretched households tighten the purse strings and tariff threats weigh on the athleisure hotspot. We're going to preview the results, bring them to you the second they hit the wire.
And a big question regarding that jobs report: is AI coming for your job? We're going to talk to LinkedIn's Chief Economic Opportunity Officer and get his take. And, well, it's somewhat dour. That's coming up a little bit later, right here on The Close. This is Bloomberg.
One stock to watch today is definitely Tesla, now down by over 10%. So here's the deal. Elon Musk and President Trump are feuding on dueling posts on social media. Elon Musk is refuting Trump's claim that the president asked him to leave the post in Washington, whereas President Trump is pushing back a lot on what Musk is saying about the bill that's in the Senate. Did you follow all that? Because we definitely didn't. So joining us to discuss is Bloomberg's Max Chafkin. All right. Knowing what you know about Musk, who wins this fight here?
I don't think either of them are going to win. I mean, you have the world's richest man. He is an important political donor. I mean, we're going to see fallout from this relationship. Trump does not want to lose Musk's money as a donor for midterms, as something he can use to get wayward Republicans to vote for these bills. I think if you had to look at who's the bigger loser right now, you have to say Musk, because Trump is sitting there, all the cameras are on him. Meanwhile, Tesla stock is crashing. And I don't think Musk has a clear political home, right? He could, I guess, try to ally with the sort of far right and with the sort of deficit hawk faction of the Republican Party. He could start a new political party, as he has sort of threatened to do on Twitter amid this flurry of insults and so on. But none of those paths seem particularly clear, and all the while you have real challenges as companies, especially Tesla.
Especially Tesla. And I am curious. I mean, when you see the 15% drop in the stock, when you see space stocks rallying, basically everything around his ecosystem, at least in terms of financial markets, working against him at this moment. The idea, and this has been the narrative that has come out over the past few days amongst the GOP, their talking points, is that Musk exists by the largesse of the government. Is that true?
You know, it's probably an exaggeration. I think you could tell a story where, and many people have told a story that is very compelling of Elon Musk as this entrepreneurial, wizard, this product inventor, this creator, this job creator. All of that is true, but it's also true that he is at core a government contractor. He is a guy who very much needs the U.S. government as a partner. And that's especially true with SpaceX, but it has been true at various times in the history of his other companies. Now, what I'll say is, it's not like Musk has no leverage. SpaceX is successful not just because the government gives it money, but because it made successful products that the government pays for. And those products, because it's been able to develop this kind of entrenched position, it's not clear who the competitors are. So, Musk has leverage, but this is not good news. And if I were in the kind of government affairs office of SpaceX, I'm not feeling super good right now seeing Donald Trump say, we're going to take away all Elon Musk's money. That is not a good sign.
You know who also probably feels really bad is the government affairs office for Tesla at the same time, when they also have, tax credits coming out of the big and beautiful bill.
Now, there, I think it's almost more about the perception among Trump voters. Donald Trump is a more important, a more influential cultural figure than even Elon Musk. And so, yes, these tax credits that are coming out of the big, beautiful bill, that hurts Tesla. It makes its cars more expensive, basically $7,500 more expensive if they go away. But the real problem is that Trump voters join Democratic voters in not wanting anything to do with this company. We already have a lot of liberals putting stickers on their cars that say, I bought this before he went crazy. I'm looking forward to the I bought this before Trump got mad at him stickers.
Okay, thank you, Max. Now that you said that, I'm sure somebody's printing those up as we speak. We should point out Tesla shares now extending their drop, down 16%. Worst day for this stock going back to 2020, which is hard to believe because this is normally a volatile stock. But I just want to get on something you pointed out with the stickers and everything. There was a lot of talk when he sort of aligned himself with Trump during the campaign. And you saw the backlash from the far left. The idea that he was damaging not only his personal brand, but really Tesla's brand to a certain extent. Exactly. And I do wonder if it's possible to reclaim that in some way.
I think Tesla makes cars that are very well regarded by car reviewers. So I think over time, if Elon Musk were to quiet down and just make some good cars, then his reputation will improve. But this is a thing that is not going to happen overnight. And I think even if Elon Musk completely flipped parties, it's not. A lot of Democratic voters already are angry. They're mad about Doge. They're mad about the things that Musk has said that they perceive as being racist or sexist. And that damage is not going to,
but it is. It would be interesting to say that.
Not going to be overturned overnight.
Yeah, I mean, exactly. And we should point out too, now he becomes kind of the whipping boy or a scapegoat, I should say, for a lot of folks in the GOP. When they do want to talk about some of the problems in Washington, they can point to him and Doge. Whether that's fair or not is up to question. All right, Max Chafkin, who covers all things Musk for us here at Bloomberg, and of course does a great job on this. We should point out right now Tesla, the biggest drag on the broader markets. That's why you're seeing the S&P and the NASDAQ sink deeper into the red. Those shares on an individual basis down 16%. When we come back, we're going to focus on the retail sector and Lululemon. They're scheduled to report after the bell tonight. We're going to update you on what to expect. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off with Coursera. Morgan Stanley cutting to equal weight. The analyst says even though Coursera is their preferred stock in the education software sector, they still see more attractive risk and reward elsewhere. Coursera shares down about 5% on the day. Next up, Texas Instruments. Bernstein upgrading the market perform and lifting the price target to 180 from 140. Though the analyst notes the shares have underperformed since 2023, he sees a cyclical recovery and that may already be underway. Texas Instruments shares, though, flipping from gains to losses, down about 0.6% on the day. And finally, Dollar Tree. JP Morgan raising its recommendation to overweight from neutral, upping the price target to 111 from 72, saying steady growth could underpin a breakout for the stock going forward. Those shares, which you should point out, were the biggest decliner yesterday in the S&P. Now, your biggest gainer in the S&P today, up about 9%, and those are some of our top calls. We stay in the retail space with the push ahead to Lululemon. The shares pulling back just a bit as we wait for the athleisure maker to report earnings after the bell. Investors will be looking to see the impact of tariffs and whether sales growth is slowing in the U.S. Joining us right now is Sharon Zackfia, head of consumer equity research over at William Blair. She's got an outperform rating on the stock. All right, the last couple quarters have been a mixed bag, Sharon. What is the most important thing you're going to be looking for tonight?
Yeah, I mean, I think that the key is going to be sales in the U.S. We've seen really strong sales for Lulu overseas. That's kind of a given right now, I think. But they need to get some more momentum here in the U.S. Clearly, it hasn't been easy in apparel, but a lot of tariff noise. We're going to look for trends to be at least as good as they were anticipating when they gave us this update on the first quarter earlier this year, and hopefully see a continuation of at least stable trends, if not some improvement expected in the rest of the year.
How much does it matter that when we take a look at comp sales and at least the expectations right now, the idea that they are looking at relatively decent comp sales, but when you sort of take into account the constant currency estimates, then that positive number flips to a negative number. Is that something investors should be concerned about?
I mean, we focus on constant currency, right? That's the most meaningful measure of the momentum of the business. From a reported standpoint, clearly you're dealing with reported currency, but constant currency is going to be your best measure of the momentum of the business and where it's headed, and that's going to be the key here.
Sharon, what's the bigger risk? Is it tariffs or is it consumer spending?
I think they're related, unfortunately, right? I mean, I think the issue with tariffs is that it can impact the discretionary income that consumers have to spend. So we clearly saw in April some pause from the consumer, some worry as these tariffs were kind of coming to fruition. I think for Lulu, they're a big player. I think they're going to be able to navigate tariffs in a way that others probably can't from a cost perspective. And I do think their suppliers will share some of the pain with them. So we're going to expect some mitigation of that for Lulu, maybe in a better position than some other players, given Lulu does have very high margins. I mean, that is one of the big benefits they have from a competitive standpoint as we think about the tariff impact on the cost structure.
On the flip side, though, there's been increased competition on the space over the last few years. So when you have a tightening potential wallet for the consumer and that heavier competition, what do you think we're going to hear on that front?
I think there's no question that this is a competitive industry. I think at the end of the day, Lululemon has to set the bar for what customers want, right? So we do surveys. We see a lot of cross-shopping across concepts, across brands. Lulu is still getting the looks. So that is great news. They have to have the product that, gets the consumer to click on buy or go up to the cash register. And I think that's what they've been working on. Unfortunately, the timing has been less than ideal, with some of the more consumer unease this year. But I think they've come a long way in newness. Hopefully we'll have a more stable period this summer where we can see what that really means for sales.
What about kind of just the general store experience, Sharon? I mean, yesterday I had a chance to catch up with Mickey Drexler, of course, a legend in the retail space, and a guy who really sort of knows a lot about, how to get people in the store. And we were actually talking about this idea of kind of the early days of Lululemon, how, you went there for your yoga class and to get coffee, and then they had the whole ethos with all the, the weird, Ayn Rand quotes or whatever. Whether you bought into that or not is irrelevant. The fact is they created a certain a sort of community around that. And I do wonder if they've strayed away from that too much.
I don't think so. I mean, I haven't seen any evidence to that. They still have a very strong ambassador, program. They kind of created the influencer. They had ambassadors before we knew what influencers were. That's been how the brand has connected with consumers. It's a very organic connection. They have not been really into kind of mass marketing per se. That actually is a lever that they could start to pull more if they need to. So I think one thing that I think people need to remember is brand awareness is still pretty low for Lululemon. It's still in the mid 30s to 40% in the U.S. That's for a company that's now doing $11 billion in sales this year globally. So, and it's a fraction of that overseas. So there's a lot of room for Lululemon to continue to broaden their reach.
That is staggering. I didn't know that. I would assume like everyone talks Lulu, but maybe this is a very like New York focused conversation at the end of the day. In general, in your space, what companies are really well positioned to manage the consumer uncertainty plus the tariff uncertainty?
Yeah, I think Birkenstock is really well positioned. They produce all of their product in Germany. The EU, as it stands right now, has lower tariffs than where most footwear is made. So they actually stack up relatively well from a potential cost perspective. That brand is also doing very well from a consumer standpoint in the U.S., in Europe, and APAC. They've got a lot of opportunity, I think, to navigate very easily, actually, through this strange environment that we're in right now.
I do like my Birks. I know that surprises Raman completely, but it's
What?
true. I know, it's true. All right, Sharon, thanks a lot. Sharon Zackfia, head of consumer equity research at William Blair. Not to work.
Oh, I see. You always got fancy, high couture.
You're right. Along with this big boot here.
I know.
With my broken foot. Okay. Speaking of broken, I don't know. Take a look at the S&P. I mean, that's a straight line down.
Okay.
0.7% here. Now, about almost half of that is Tesla, but you can just see that momentum picking up as we get to the close.
Yeah, and interesting too, because we should point out, we had seen weakness earlier in the session, so we were kind of headed in this direction. But obviously, whatever cat fight's going on between Elon Musk and Donald Trump, not helping Tesla shares and not helping the broader market. No,
it's just fascinating to watch all of this unfold. One stock, one area that potentially is immune is an IPO of the ages, and that's Circle. It's up 155%. We're going to speak to the co-founder, CEO, and chairman of Circle, Jeremy Allaire. He just hit billionaire status after this IPO. Stock has tripled in its first day of trading on the New York Stock Exchange. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So we're definitely rolling over within the market. A huge part of that is obviously due to Tesla, accounting for almost half of the decline that we're seeing in the S&P.
Absolutely. And we talk about a market that was already a little bit on edge. We started the day, we actually did see a decent rally. The idea that at least on an intraday basis, 20% off of those April lows. But that started to fade largely because of concerns about trade, lack of details on that China G call, and of course some trepidation heading into tomorrow's jobs report.
All right. Well, one stock still doing well, and by well is an understatement, is Circle. Shares are up a whopping 158% after being halted for volatility. The stablecoin issuer's shares at one point surged as much as 235% after it IPO'd today. It would have marked the largest first day pop for a U.S. IPO, raising more than $100 million since CureVac back in 2020, but the whole market kind of losing a little bit of steam. Joining us now is Jeremy Allaire, Circle co-founder, CEO, and chairman. Jeremy, huge day, stock, huge gains. Congratulations. It's always hard to get this really off the ground. Do you feel like you left a lot of money now on the table?
Look, I think we're very, very happy to be becoming a public company today. This has been part of the journey that we've been on. We're thrilled to have so much investor interest in the company. We executed, I think, a really great roadshow and found that across every sector, from major mutual funds to long onlys to family offices, hedge funds, sovereigns, retail, across the board, there's a lot of interest in investing in stablecoin platforms and networks like Circle. And so it's been a tremendous day, very proud moment for all of us here at Circle.
What are you going to use the money to expand for?
Well, Circle has grown quite a bit over the last several years. We're profitable and generating cash. And so, there is a component of cash in this IPO. We're in a period where we're going from the early adopter phase of this technology to the mainstream scaling phase. And as we go into that mainstream scaling phase, there's extraordinary opportunities to grow and expand internationally. We're building many new products, kind of building more infrastructure that's necessary to get ready for large-scale internet companies, commerce firms, banks, building on this. We're building new products that really try to make this an easier to use technology for everyday payments. And so we've got product investments, we've got growth expansion. There's a lot to do. And I think this really represents the internet kind of colliding with one of the largest markets that's ever existed. And we're part of building this new internet-based financial system, which is one of the largest target markets that the internet has really ever gone after.
As you start to do that, there's been a lot of discussion here about new entrants into that space, and I don't necessarily mean startups. I mean the big sort of tech companies out there, as well as some of the big financial institutions that might decide to go the stablecoin route in some shape or form themselves.
Well, we really do think that major technology firms, major financial institutions, major commerce firms are going to go the stablecoin route. And we think that they're going to look to partner with the leading platforms and the leading infrastructure that can bring the technology, the scale, the network effects, and really the broad regulatory footprint like Circle has provided. We are one of the most widely licensed and regulated firms in our space. As you know, there is a bill in Congress with super majority support in the Senate, the Genius Act. And I think as these things come to pass, that's going to create real demand to build with internet platform infrastructure companies like Circle. So we really are excited about all those firms getting into this because it's a tremendous opportunity for us to work with so many of those companies.
And part of that debate as well, Jeremy, as you know, and I'm just playing devil's advocate here, is of course the question as to why we necessarily need the tokenization through a stable coin or through, I guess, a money market type of fund, if you will, rather than just doing some type of tokenization right off of people's bank accounts.
Well, one of the core tenets behind what we do is issuing a fully reserved digital dollar or dollar digital currency, full reserve money that can work at the speed and velocity of the internet at scale is so key. We don't want the base layer of money on the internet to be fractionally reserved. We don't want credit IOU risk in the money that is free circulating on the internet. And so we think from a monetary perspective, from a safety soundness perspective, we need this ultra safe form of digital cash money. And that's why central banks and prudential regulators all around the world agree with that. That's why the rule books that are being put in place enshrine in law that safety in these digital cash instruments. We think this is the right foundation for the internet financial system.
On that end, that makes sense in terms of safety. But if you're not FDIC insured, how can you really appeal to a broader array of individuals?
Well, one thing to remember is that banks are FDIC insured because they take 12x leverage with your deposits. They're huge risk-taking institutions, whereas a stable coin under these rules, under things like the Genius Act, are only able to hold these high-quality liquid assets, ultra-secure and safe, short-duration treasuries, treasury collateralized repo, the safest assets in the world. And of course, we do need to hold capital. We need to think about the market and liquidity risk of short-duration treasuries. But that's very, very different than a levered-up deposit base, which is why they have to hold 8% capital and why they have to participate in these insurance schemes. And so FDIC is really designed around risk-taking money. We want ultra-safe, very sound, full reserve money as the foundation of the internet financial system. It's a step forward in the safety and soundness, I believe, and the ultimate efficiency of how money can work in the world.
I mean, maybe you already answered it, but a little bit to that point, why shouldn't we use tokenized bank deposits as the currency of the internet instead?
Well, I mean, policymakers and central bankers and all of those that are focused on this are focused on making sure that we have these digital cash instruments, things that could be treated as cash that don't have embedded risk. If we're circulating around bank credit risk all around the internet, that's actually terrifying. If we have this very high velocity money that literally can move at the speed of the internet with transaction costs at a fraction of a cent that can settle in a fraction of a second all around the world, we need these to be as safe as possible. That's why stablecoin money is such an innovation. It is effectively a new form of M1 electronic money. And we think the world is figuring that out. People, households, businesses, financial firms are all figuring out this is a better form of money. It's a money born of the internet age. That's what dollar digital currency represents. And we think it's the future of the financial system.
As that sort of expands, Jeremy, how are you going to address some of the issues with regards to fraud, criminal activity, some of the other things that we know that other parts of the crypto sphere, not necessarily stable coins themselves, but of the crypto sphere that have arisen, and I know to some extent, at least prior to the current administration, were being addressed or trying to be addressed through regulation?
I mean, regulation around the adoption of this is happening all around the world. Every major government is putting in place regulatory regimes around intermediaries that are involved in working with digital currencies, working with blockchain technologies. Companies like Circle are really advancing the state of the art. We just recently launched Circle Payments Network, or CPN, which provides a trust and compliance layer for regulated financial intermediaries to use stablecoins as a settlement layer, but to do that with known entities involved in those transactions. So it's really being both baked into the regulation. The industry is developing, I think, important novel technologies, and we can do all of this while also improving privacy and security for people, which is a real issue. You think about the data thefts and the kind of honeypots of information that have plagued so many people and affected them with fraud in the existing financial system. We think we can improve on that by building on this open, transparent public infrastructure of blockchains.
All right, really appreciate you taking time for us. I know you must be exhausted. Congratulations. Jeremy Allaire there, Circle co-founder, CEO, and chairman. 34 million shares sold last night at $31. A strong open today and now popping up to about $79 a share, up more than 157% off of that IPO price. That is the biggest gainer of the day across all of the tapes. When you take a look at the biggest decliners, Brown-Forman at the top of that list, and next right below it is Tesla. Those shares at 1 point down about 17%. Amid a very public spat going on right now between Elon Musk and President Donald Trump. Musk calling the president's claim that he had asked him to leave his post in Washington a, quote, obvious lie. Donald Trump punching back, Musk punching back again, and the catfight continues. Ed Ludlow is somewhere out in the wilds of the West Coast. He joins us right now to talk a little bit more about this. And I guess the big question is, Ed, in the context of financial markets, you got the stock down on Tesla. You have a lot of its peers, whether in the EV space or peers with regards to SpaceX that are publicly traded, all rallying today on some sort of anticipation that this fight could potentially lead to some of his government contracts and other government legresses being pulled.
Yeah, I mean, Tesla is the kind of publicly traded proxy for Elon Inc., right? The stock is down 13.8% right now, but at one point in the session, if it was down 18%, then that puts it on track for its biggest intraday drop in 4 years. This is very serious, is my point. We've been reviewing, and we can get into it, about the recent reporting of Musk's time in the White House and his departure. But the reality is that across Tesla and SpaceX since the year 2000, the company's had more than $20 billion of grants and government contracts and subsidies, right? And the Trump trade as it related to Tesla prior to November was just one of association between Elon Musk and the president. The idea that he would have the president's ear away from Doge to influence policy, the manifestation of that being robo-taxi. And what you're seeing, and what I'm hearing from the markets and what I'm hearing from people close to Elon, is the concern is now that those initiatives are just not realistic given the volatility of the last few hours in their relationship. I mean, I don't just mean markets.
I mean, but to some extent, that was already question marked, right? So right. I know this is a weird question, but what is the market reacting to? Like, is it the fact that Musk is clearly still distracted when it comes to what's happening in D.C. and less focused on product? Like, will it really impact sales of vehicles? I mean, like, I wonder specifically what is making investors so stressed?
Not a weird question. It's, I'm here in San Francisco at the Bloomberg Tech Summit, right? I'm literally in a room with all of these investors and tech CEOs who are on their phones scrolling the timeline, trying to work out what the net effect of this is. I think that the most distilled version is what Elon Musk wanted to achieve through legislation and Congress as it relates to Tesla and SpaceX. So if you take robotaxi, for example, we reported on Friday, citing sources, that Elon has been phoning lawmakers to try and affect the content of a bill that is passing through Congress right now that relates to autonomous driving. And again, the logic of the market was that if the future of Tesla is autonomy, where it operates a proprietary robotaxi service, it needs a federal framework that allows for purpose-built robotaxis on public roads.
Yeah.
The reporting was clear. He's trying to influence that, but he was leveraging his close association with the president. If the president is not a fan of Elon anymore, he has less leverage in D.C.
All right, Ed Ludlow out there on the West Coast, you see Tesla shares down 15%. I just want to reiterate, though, too, you are seeing a lot of activity in a lot of those space and satellite stocks. EchoStar up 16%, rallying on the back of this. And we should point out AST Space, a potential competitor, formidable competitor to SpaceX. That's up about 4%. We do want to go to another big mover on the day, and that is Brown-Forman. They're falling in the opposite direction, the biggest daily loss going back to 2008 after disappointing earnings earlier today. Of course, this is the parent company of Jack Daniels. To speak a little bit more about this and some of the issues that we learned in the most recent earnings report, let's bring in Kenneth Shea, senior analyst of beverages, tobacco, and cannabis over at Bloomberg Intelligence. Is this all about tariffs, Kenneth?
Hi, Raman. No, not really. The negative reaction was certainly a disappointing one from the market point of view in terms of the company's fourth quarter sales and EPS, which disappointed, single digit, kind of high single digit. What was more alarming, though, is their guidance for next year, their fiscal year for 26. And, prior, the street thought that perhaps, the liquor industry was going to rebound somewhat, near term. I think today the company came out and kind of threw cold water on that. They're guiding down now to low single digit for both sales and organic operating profits. And the problem that they see is something longer term. They couldn't put their finger on it, but they believe that, it's macroeconomic conditions. It's all the uncertainty that's out there, the low consumer confidence. But I think the market is now seeing more of a longer term recovery needed. I mean, think about over the last couple of years, the proliferation of things like GLP-1 drugs. There's 20 million people on these drugs now that have said they're drinking less alcohol. There's the proliferation of legal cannabis. 80% of U.S. states, you can buy legal cannabis in some form. There's the proliferation of hemp-based THC beverages you can buy in mainstream liquor stores in half the country, positioned right on the shelf next to beer.
Yeah.
These are things these companies didn't foresee last year that are real factors weighing on these results.
Is that structural or cyclical?
I believe there's more secular problem here for this industry than they want to hope for. I certainly can sympathize, the chatter about, weak consumer confidence. A lot of consumer companies are saying that. But a lot of consumer companies aren't seeing depletions, retail takeaway in the mid-single digits sustained for the past year. So I think these companies are having a harder time convincing people that the recovery is right around the corner. I think the market is now seeing it in a different light.
Really interesting, Ken. Thanks a lot. Really appreciate it. One of the best, Ken Shea of Bloomberg Intelligence, joining us there. We are off the lows of the session, but we're still down by 0.4%. And it looks like we're still looking at Tesla making up almost all of the decline, basically.
Yeah, this is it. If Tesla weren't down 14% now, we'd probably still be in the green. We should point out NVIDIA, Apple, and Palantir, some other big names, are also deep in the red as well, and that's providing a drag.
Yeah, a little bit there, definitely. Okay, we're 15 minutes away from the close. We're going to take you to those closing bells with Jay Woods, a chief global strategist at Freedom Capital Markets. So this is all the noise, and then we get the underlying data tomorrow, and that's the jobs number. Will that actually be enough to provide a signal? How are we positioned then for that? A key question in the market. S&P trading down 0.3%.
We're just about 10 minutes away from the close. A lot to parse on what has been kind of a bananas day. I'm Romaine Bostick. You're Alex Steele.
I am. This is true.
Yeah, wrap your head around this, because you had an S&P at one point that looked like it had reclaimed, or at least gone back 20% off of those lows, at least on an intraday basis. Then it plunged almost 1% because of some of the drama surrounding Tesla, and now it's just kind of splitting the difference.
Right, and if you take Tesla out of it, the S&P would be down just a few points. So you take a look at that. So it also proves to me too that the sentiment investor conviction's really light. Like sentiment is flippy. I know that's not a word, but I'm going to say it.
That's a word. Yeah.
and the sentiment's just not really there. There's not a lot of conviction in what we're seeing.
And we've talked a lot about that as we saw this kind of march to 5,900, and then it kind of stall out at 5,900 as well. I mean, we were remiss. I know we want to talk about, the stuff that's fun, including the cat fight in Washington. But, we have a big jobs report tomorrow. You got a big inflation report next week. And you have a lot of deadlines with regards to trade that still have to be resolved. And look, we had a call today. Remember the call between Xi and Trump? Did you forget about that already?
I did, because that
should have
was
been
like
a positive,
6 hours ago.
right? I mean, they finally got on the phone, but of course.
But it was a positive. That's when you saw stocks feeling a little buoyant.
Yeah, they bounced hard off the intraday lows on that and looked like we were headed for a pretty big rally. Then, of course, some cold water simply because we did not actually get a whole lot of details into progress that would actually lower those tariffs. Let's bring Jay Woods into this conversation. He's the chief global strategist at Freedom Capital Markets, helping us count you down to the close with just about 8 minutes to go. I want to start off first before we get to the fun stuff. I do want to start off first with that call, because you really did see a big shift upward in sentiment when we got the news, which actually came from China, not from Trump for the first time, that they had held a phone call, the first call between these two since Trump was inaugurated, which I kind of surprised me that they haven't spoken. I think that had to be taken as a positive sign that at least maybe there is some progress on trade.
Without a doubt. Scott Bessent just said it a week ago when the market was stalling ever so slightly that it's going to take Trump and Xi to actually talk. And now that they did, we got a little rally. I think the market was losing a little steam, and now we have a soap opera going on in real time. And these are the days of our lives. It did. I forgot about that call this morning. I really did. That was the catalyst for us going higher. And now there's a lot of noise going on. But, Tesla's losing market share, but one stock is gaining it, and that's Broadcom. And that doesn't get enough love. And I think we need to focus on that.
Well, let's talk
today.
about that, because Broadcom does report after the bell tonight. Is that an AI story?
It is. I mean, it's NVIDIA's, younger brother. NVIDIA's up 1,250% over the last 5 years. Broadcom's only up 500%. But over the last 52 weeks, Broadcom's up 85%. NVIDIA's up 15%. Broadcom has broken out. I'm a technician. I love my charts. It's broken out ahead of earnings, kind of like what CrowdStrike did. If it retreats, it could come to a level where it's still active. It's still looking good from a technical point of view. And then they acquired VMware. People forget about this. There's a software story there, $69 billion acquisition. So from the fundamental point of view, they're seeing the fruits of that finally come to fruition. So I'm curious to hear what they say. Their guide is usually a little skeptical, but if you avoid saying, tariffs are impacting us this much, then maybe you'll be okay. But Broadcom, a big player on the stage, and it gets lost in the shadows of some of the other magnificent names.
I mean, sure, but it's still one of the crowded semi-longs over the past 5 months. So it's definitely hasn't getting recognition. So it would, in some ways, if it's so crowded, be no surprise if we then sold off that things weren't good enough, etc. But to that point, which brings us back to the sentiment, right?
Yeah.
And positioning. How is it right now?
Sentiment is actually better than it was. I think the last time I was on the show, we were at historic lows, which I said, as a contrarian, that's where you want to get in, you want to buy. We've had a ridiculous rally, a relief rally, almost a V shape. It's not V until we make new highs. We got to watch that 61.44.15. We're getting there, but I think we're losing that momentum. Earnings season pretty much over. We have Broadcom and we have Adobe and Oracle next week, but it seems like we need that next catalyst to take us higher. I don't see it.
So I was going to say, so what is that? I was asking this earlier in the show too. Is it actual good news, like inking a deal with a trade partner other than the UK, or is it just no more bad news? Then we eventually grind our way to that new high.
Yeah, we're waiting for those 90 deals in 90 days.
So you do need Harding.
We need to see some progress. We had it this morning on that phone call, which was good that they talked. But what came of those talks? We don't know. So it's kind of getting tired. I like the fact that we made back what we did. But what is the catalyst to take us higher? There's still uncertainty. No one knows what these tariffs are going to be when it stops going back and forth. The taco trade still in play. He hasn't backed down. In fact, he doubled up on steel on Friday. My fear is the rhetoric gets a little crazy. He doesn't want to be seen as a chicken, as taco means Trump always chickens out. And he does something that will look forceful, but the market could react negatively to it.
Well, I mean, let's we got to get you to get your thoughts here on what's going on right now with Tesla, the huge drop in the shares, and this is not insignificant. We're talking about top 10 in the S&P in terms of its weighting, down 14% now. A very public spat really playing out today. Musk obviously concerned about some of the stuff that's in this budget bill. Maybe it's just because of the EV mandates aren't in there. Trump pushing back, saying I kicked him out. But now it seems like the investor sentiment is like if Musk doesn't have close ties to the White House, that somehow his business, not just Tesla, but also SpaceX, also Starlink, and all these other businesses might actually suffer because they are, to a certain degree, dependent, if not on government contracts, maybe subsidies and some other types of government regress.
Musk is damaged goods right now. He's getting it from both sides, the left, the right, and now the president himself. We're seeing the stock, the shareholders are just, they're done. Technically, it did hold the 50-day moving average. There may be hope. They do have an event next week with the robo-taxi in Austin. They need that to go well. They need the AI story to play out. He needs to show what the next big thing is, because this AI story is starting to wane and wane quickly.
So Tesla has its own moving factors right now, and I wonder if we don't need the Mag 7 anymore. We need a different acronym, and like who should be in that at this point?
Broadcom, without a doubt. I've been yelling Broadcom is one of the most important 7 stocks out there. No one's going to put Uncle Warren in there and Berkshire Hathaway. It's the most important stock in the world. It just slowly, steadily goes up. No headlines, nothing to worry about. But yeah, Tesla right now, they still have a technology story. There's still an AI play there. Robotics could be game changing. I don't think it's over. But right now, with this drama going on, I'm not going to venture a guess that this is the worst of it to come, because there could be shots fired that personally hurt his fortune going forward.
And also to that point, too, because there were some fundamental issues going on. There were a lot of people talking about this recent crash regarding a Tesla autonomous vehicle and the idea of whether the technology that Musk has been using is not necessarily as up to snuff as LiDAR, which we know some of the other companies have been using. There's also been a lot of concerns also about whether there could be a competitive alternative to Starlink. And I know SpaceX is, at least right now, I mean, unless Boeing gets its act together, not really a viable alternative. But there are some real companies out there that, in theory, could maybe take a bite at the apple of what Tesla has kind of had all to itself for the last few years.
Without a doubt. And watch these satellite companies. They're rallying on this news because it's negative for Tesla. The EV companies, EV, really not much of a story. In fact, this big, beautiful bill was killing the EV subsidiary, which some people are saying why he's so upset. But Tesla right now has got to show and pivot away. Waymo, when you talk about driving cars, Waymo is crushing it right now, but they don't have that magnanimous CEO that's going to go out there and really pound the table. They just get results, and eventually it's going to pay for it. They're the number 2 autonomous driver out in San Francisco right now. They're ahead of Lyft and behind Uber now.
I've been in a couple of them already. Jay, got to leave it there. Jay Woods, always appreciated, Chief Global Strategist over at Freedom Capital Markets. Just about a minute or so until we get to the closing bells. Alex, down 0.6% on the S&P 500. It could have been worse, but of course Tesla, the big drag, down about 14%.
Yeah, and then you have to wonder too then what we do with the fundamental data that we get tomorrow with that jobs number. Options expiring on June 6th apparently is looking at 175 basis point move for the S&P on that jobs Friday. All
right, Jess Menton joins us right now, who helps to lead our markets coverage here at Bloomberg. She's going to help take us to the closing bell and beyond. And Jess, kind of talk about the market action we've seen today. There have been so many catalysts, both to the upside and the downside. Let's set aside Tesla for a second, because that's its own story. But what's really moving things right now?
Well, really, if you think about not even just today's session, but the past 7 sessions or so, it's really been more of kind of a listless moves in the S&P 500, even though it's trading, less than 3% away from that all-time high that was last reached on February 19th. So when I'm speaking to a lot of technicians, Jay Woods including himself, who I speak to a lot, when it comes to those,
he said his first question
of course,
Guest, by the way, but okay,
I'm right here. But when you think about all those resistance levels, whether it's from a technical perspective or from an options dealer perspective, around 6,000, you got to get back above that level to get closer to those all-time highs above 6,100. So it's been a little tricky here after that best May for the S&P 500 since 1990.
We're going to talk a lot about technical levels. We're going to talk a lot about the superlatives that could have been with an S&P 500. Right now, down roughly about 30 points as we wait for these numbers to settle. We get the closing bells here in New York, and S&P going to close out the day right around 59.39 and change, down about 0.5%. The Dow Jones Industrial Average down more than 100 points, or about 0.25%, while the Nasdaq Composite is down about 0.8%. Similar move lower by the Nasdaq 100. Of course, Tesla being the big drag, and your relative outperformer on the day, guys, that's going to be the Russell 2000, which closes out the day down by just 1 point.
Yeah, taking a look at the individual sectors within the S&P, all of them mostly in the red. Communication services really trying to eke out a little teeny tiny tiny gain, but honestly, the big drama is in that consumer discretionary space because of Tesla down almost 2.5%. Consumer staples also a little bit heavy here, off by over 1%.
Yeah, and you take a look there at the 11 S&P sectors there, only one is in the green, and that is communication services. All of the others are deep in the red, and that was largely because of some big gains that you saw in Live Nation and Match Group. We should point out, of course, the biggest drags coming today, you're going to find that in the discretionary space, which, of course, also includes Tesla as well.
Let's get to some of the movers then and what's on and off and individual sectors here. Jess, let's talk about the upside.
That's right. So I wanted to point out what's going on in the IPO space because we did have Circle, CRCL was the ticker symbol on this. So stablecoin issuer, it actually soared over 200%. And so actually, when you're thinking too, as far as its selling shareholders raising about almost $1.1 billion in this IPO, stock open just below $70 a share. Actually, the expectations were for it to be around $27 to $28. It actually ended up pricing at $31 a share. So some optimism there when you're thinking about what that means for the ECM front. And then some other ones I'm keeping a close eye on as well is also when it comes to Dollar Tree and what's happening with that retail story there, because obviously we've had a mixed bag here when it comes to some of those. And if you look at Dollar Tree, up about 9% on pace. Actually, it's closing at its best day since March 27th there. And it did come, even though on the back of yesterday, it lost more than 8% on some mixed results because of tariffs. But JP Morgan had that upgrade on the stock that made it soar.
And we should point out we are awaiting some additional retail earnings here in the after hours, including from Lululemon. We're actually getting one right now. This on Rent the Runway. The share is not really reacting too much to the numbers, with revenue coming in at about $69.6 million. The loss per share at $6.58 a share. The company also saying that active subscribers in the most recent quarter, 147,000 and change, relatively in line with estimates. The company saying that they are, quote, happy with the sequential growth in ending active subscribers.
Yeah, you have to wonder too, sort of how that works when you get into any sort of difficulty with the economy and then consumer stress. Is that actually necessarily potentially a good thing? Okay, so what else are you looking at? Norwegian Cruise, right?
Yes, of course. So I wanted more in the travel space. Peyton Fort, our equities team, watches the travel stocks very closely here. So NCLH is the ticker symbol on this. It actually was up more than 5% today, so that was its best day since May 12th, and that's important just given that their stock is rising as those analysts seeing those improving booking trends here as we're going into the, of course, travel season here. And then Stifel analysts were talking about how their management companies were also more optimistic when you're looking around those booking trends compared with just a few weeks ago. So some optimism there when it comes to traveling.
They also talked a lot about that they're actually keeping their costs under control too.
Yes, and that's a big thing too when it comes to those costs, and then any sort of other impacts kind of more globally when you're thinking about the economy.
Let's go to the negatives. Tesla, I'm sure, is on this list, which we'll be breaking down.
So 14% downside today. So worst day since March 10th. Obviously, when you think about especially going from friend to foe for Elon Musk between also President Donald Trump here. And it was perceived that big run we saw in Tesla stock, especially after the election, because of the anticipation, not just for the EV company that Tesla is, but also the anticipation of what types of even protocols or things that could be passed that could help, because Tesla wanted to transition more into an AI company. Obviously, we have that event coming up with those robo-taxis later this month. But what does that mean moving forward when it comes to something like that? And then also on the downside, Brown-Forman. So this is a liquor company. Also, Jack Daniel's whiskey distiller here, down 18% today. That was its worst percentage drop on record, and also the lowest close in more than a decade. So it saw a net sales decline in the U.S. and also developed international markets, unfortunately.
Was this a story about tariffs, or are we just drinking less?
So apparently, some people are beginning to drink less, but some of it also because of the international scope. It actually was tied to tariffs there. So they're thinking that also emerging markets was another kind of bleak spot there, unfortunately. So a little bit of surprise there when you're thinking about what's happening when we're in the liquor type of space with these types of stocks.
We were talking to Ken Shea of Bloomberg Intelligence, and he was saying maybe we're looking at a structural shift as well, as people may be turning more towards hemp-infused or pot-infused drinks instead, and just sort of moving away from some of that hard liquor.
I do want to get to some of those earnings that are crossing the wire right now. We are waiting, of course, on Broadcom just a little bit later, but Lululemon crossing the wire right now. Net revenue in the most recent quarter, $2.37 billion, just a touch above the average of street estimates of $2.36 billion. EPS right on the nose of what the street was looking for at $2.60 a share. Gross margin above estimates at 58.3%. Here's your guidance guidance going forward. The company says for the current quarter, net revenue should be in the range of $2.5 to $2.56 billion. The top end of that range is below the average of analyst estimates. On the EPS side for the current quarter, EPS of $2.85 to $2.90 a share. The street was looking for $3.31, so that would be a big miss if that did hold. The full year revenue forecast, Alex Steele, $11.15 billion to $11.3 billion. Once again, slightly below the average of street estimates. They were looking for $11.29 billion. The net effect of it all, Alex Steele, is a decline in the post market of about 11%.
Yeah, R is trading heavy into the close and the print as well. All right, I'm looking at Rubrik, the infrastructure software company. Here's a look. It's a different story. The loss per share was actually much better than estimated, coming in at 15 cents versus the estimated loss of 32 cents. Also taking a look at subscription revenue coming in at 1.18 billion. That also beat. Also total revenue beat as well, coming in a little over 278 million. And then to top it all off, its second quarter revenue is also stronger than estimates on the top line. They see that as $283 million. Their range loss for that second quarter for earnings also coming in a bit better, between 33 and 35 cents a share, guys.
And I'm looking at Vail Resorts, so luxury ski resort company here. And of course, if you're looking at what's happening with the latest news here, it sees third quarter net revenue actually between 1.3 billion. The estimate was actually 1.31 billion, so coming in just shy of those expectations and those EPS estimates for the third quarter, about $10.54. The estimate was actually $10.02, so coming in just above that as well. So this is important because generative AI is going to have a huge impact on how some of these large corporations have and do their businesses. And so surprisingly, this is actually one of those things that people are working at, but also Vail down 18% year to date. Let's
go to DocuSign. Those shares down about 11% right now. Kind of a curious report here. First quarter adjusted EPS and first quarter revenue did beat $763.7 million and adjusted EPS at 90 cents. The street was looking for 82 cents. The guidance also above estimates. 2Q revenue guidance of $777 million to $781 million, well above the average of street estimates. And a similar story on the bottom line. Subscription revenue coming in above estimates and a $1 billion boost to the share buyback program. We'll have to dive deeper into that earnings release to see why we're seeing such a negative market reaction.
All right, let's go to Petco here, ticker WOOF. The net sales for the first quarter just met estimates. Taking a look at net sales of a $1.5 billion decrease year on year, so coming down by about 2.3% year on year, I should say. Comp sales also decreased 1.3% on a year on year basis. So overall, the company, though, meeting those estimates. Raman?
All right, Alex, we're going to say goodbye to Alex Steele. We're going to say goodbye to Jess Menton for their help in breaking down all of the market action here on this day. Of course, the close does continue with no breaks. A lot of news to break down, a lot of earnings to break down as well. We talk about the movers in the after hours trade, the big drops that we're seeing in Lululemon, DocuSign, and others. And of course, the big drop we saw during the cast session in Tesla. Those shares having one of their worst days in years after tensions between President Donald Trump and Elon Musk flared up very, very publicly. Musk saying that Trump's claim that he had asked the Tesla CEO to leave the administration is a lie. A tit for tat on Truth Social, and of course firing back on X. Ross Gerber joins us right now. He's the co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management. All right, Ross, there's a lot of talk, and I know we're going to have a lot of fun, of course, with this public spat, but there is material damage here when you look at what happened to the shares, and more importantly, you saw the bids higher in some of the, the potential would-be competitors, not necessarily the Tesla, but the Starlink and SpaceX, like AST, like EchoStar. What do you make of this?
Yeah, this is a disaster for Musk. I don't know if I can spin it in a positive way because it's just so beyond any intelligent businessman's behavior would be. I can't imagine after putting Trump in there that he would then turn Trump into an enemy of all things, because he's still the president of the United States. And Elon just tweeted something like, well, I'm going to be around for another 40 years and he'll only be around for another 3.5. And I think that's really ignorant thinking, because Trump is president of the United States, whether we like it or not, and Elon's going to have to live with this for quite some time, and it could be very detrimental to him and his companies.
And this brings up a good question just about leadership in general. There's been a lot of talk when with this new administration, how CEOs were able to navigate, and we've seen a lot of CEOs do it well. For better or for worse, a lot of them have gotten pats on the back for the way that they've courted this administration. Understand that for better or for worse, these are the people in power, and you have to at least appease them to some extent. And I do wonder about the leadership at Tesla and the idea that he's making this much more personal and not understanding that he has a duty not just to himself, but to all the stakeholders in his companies to find a way to be cooperative with this government in some way or another, particularly given how much his business depends on government contracts.
Correct. And obviously Elon isn't functioning to the benefit of his shareholders and hasn't been for many years. And, you know, you can take it any way you want, whether it's the purchase of Twitter, the, you know, XAI, and now this whole political disaster. None of this has been good for Tesla shareholders, and I've been saying this now for years. The board of directors is so bad at Tesla, and let me tell you, there was just a letter that's many shareholders from institutions and pension funds had written the board of directors about Elon Musk and reining in this kind of behavior. And I can't assume that this isn't going to lead to massive shareholder lawsuits against the board of directors and Tesla for the loss in value from this behavior, which is clearly detrimental to its shareholders.
Why not make the change? Look, I understand that he has kind of a singular identity with this company, but why not just move him to like a chairman role or something and bring in a real operational person? I mean, you think about the success that SpaceX has, and a lot of people talk about that primarily because he's not really in there making the day-to-day decisions. He actually has someone competent running that, and I think that's why a lot of people, quite frankly, are championing at the bit for that company to go public. Isn't it now time? He's been at the helm of Tesla for so long, and you've seen the damage over the last couple of years. Why not just make that switch now?
Yeah, well, the next is going to be the damage to SpaceX, because SpaceX relies on almost 100% on governments around the world and the U.S. government to fund it. And this is an easy target because we don't need to go to Mars, that's for sure. And so who's going to pay for all this stuff? And, you know, the truth is that SpaceX valuation was probably cut in half today because of this behavior. Whether SpaceX investors will realize that on the short or medium term, because it's a private company, it's insulated from the stock market. But this is, you know, devastating to SpaceX as well.
Hey, Ross, sorry, just to cut you off here. We're actually getting some additional news on Tesla right now. The share is extending their drop out of the cash session now in after-hours trade down 2%. The headline is that SpaceX will begin decommissioning Dragon spacecraft. And Elon Musk, in a post on X, is saying, and I'm going to quote him directly, "In light of the president's statement about cancellation of my government contracts at SpaceX, we will begin decommissioning its Dragon spacecraft immediately." I'm actually a little stunned by this. Not just that he did it, but why do this so quickly right now? I mean, this has all just transpired over a matter of hours. And now you're basically saying he's decommissioning one of their flagship projects? Am I missing something?
Somebody needs to come in and get him off the phone and get him to stop tweeting. There's clearly no, you know, control over what's happening to what is the dismantling of the Musk empire in real time as we're watching it. Somebody needs to stop this guy, whether I'm not going to assume he's on drugs or not on drugs, but somebody's going to stop him.
Yeah, well, let's not go there. But who's going to stop him? I mean, I'm looking at the board. 9 people on this board. At least 2 of them are, well, one's him, and obviously his brother. You got Murdoch. You got a couple other people like Kathleen Wilson-Thompson, and you got, of course, Jeff Straubel on there. You have a couple of respected names here. But I just wonder, is this the type of board that can actually push back? Where is the pressure going to come from?
No. The board of directors of Tesla is the weakest group of individuals that have ever stepped foot on a board. Okay, I can't be more direct about the fraud that this board is. You know, it's just embarrassment to public companies across the globe that it exists in this manner. And this Chipotle guy who just got on the board the other day, poor guy. You know, I realized that when I was thinking about running for the board, what a bad idea that was. And so I reversed that idea, you know, pretty quickly in dealing with what was going to be dealt with. So the board isn't going to do anything. Yeah. Nobody's going to protect Tesla shareholders. And the way you protect yourself is by selling stock. And that's, I personally sold some Tesla stock today. And you know, we've been sellers for years and continue to be sellers of Tesla.
All right. That we point out, you're referring, of course, to Jack Hartung, who just took over, or was added to the board, I should say, on June 1st. Ross, we have to leave it there. We should point out Tesla shares continue to drop in the post-market trade. You're seeing a lot of other space companies like Rocket Lab continue to rally. They had rallied in the cash session, now rallying in the aftermarket session as well. We do want to continue our conversation here about the earnings that we were expecting. We are getting Broadcom earnings crossing the wire right now. The knee-jerk reaction to the report is shares are down. The second quarter adjusted EPS coming in at $1.58. That is a beat, a slight beat. The street was looking for $1.56 on average. Revenue in the quarter came in at $15 billion on the nose, a slight beat. 14.96 was the average of analyst estimates. The company guiding for the third quarter, its fiscal third quarter, saying that revenue should be about $15.8 billion. The street was looking for $15.72 billion. So at least on the top and bottom line for the most recent quarter, you have a beat. With regards to the guidance going forward, that does appear to be a beat, though we should point out it is a relatively small beat. Commentary in the statement right now, they talk about AI revenue growing 46% year over year. Let's bring Ted Mortonson into the conversation, Managing Director and Tech Strategist with Baird. Ted, I know you haven't had a whole lot of time to dive through this, but so I'm going to put you on the spot. When you see a reaction like this to the downside, despite modest beats, and look, I know we're just talking about a couple $1 million here and there or so. What were investors expecting coming into today's report?
They were expecting a bigger beat, obviously. The shares had rallied into the print. And after NVIDIA, the institutional community has two names to offset each other. One's NVIDIA and Avago, and they're overweight both. So when you don't see a substantial beat, you're going to retrace a little bit.
I thought that they were actually benefiting from the whole data center build out.
They certainly are, but they're benefiting from the cloud titans with design. So that's about a third of their revenue. If you look at NVIDIA, that's a platform sale, and they're going head to head with each other. Quite frankly, almost a clash of the titans here. So. People were looking for more on the earnings. The other thing that when I talk to institutional clients, I think one of the biggest things is roughly 45% of their revenues are coming from software. And this is very sticky old software. And VMware has operating margins in the 70% range. Okay. And I think where the new competition's coming from NVIDIA Dynamo, as well as Nutanix and IBM, and I think that's kind of under the microscope with some investors.
So has that not been integrated well, though? I mean, because I know that there was a lot of sort of, is this a good deal? Is it not a good deal? The consensus seems to be this is a good deal.
Yeah, it's a great deal. Hock Tan is a genius. However, he also raised prices on his enterprise customers by about 30%, and they're not so happy.
I'm curious, too. I mean, just a couple days ago, we had heard about this new chip that they're finally getting, Broadcom's getting out the door, and the idea of sort of being an accelerator. And I don't want to get too into the weeds of this, but this was kind of NVIDIA's advantage, right? The idea that these processors were more than just processors. They really had a way to supercharge the whole data collection, data parsing processes. Right. How does that chip stack up, the Broadcom chip?
It's really tied, I think, to more of the merchant silicon area. Arista's using a lot of Avago chips and also the cloud titans. But if you really look at NVIDIA, what they're doing on Blackwell and Rubin, and then combine what they're doing on the networking side, boy, I tell you, NVIDIA is probably a cycle ahead of Avago in some respects. And if you're doing an integrated buy, NVIDIA's got quite the interesting advantage.
All right, so once the conference call comes, I mean, what do you want to hear them articulate? I mean, what's the real strategy that you want to hear out of their mouths and say, okay, look, here's what we're going to do next. Here's what maybe can get us to a point where we are a much more formidable competitor than where we are today?
Well, Hock in 2020, he basically alluded to a couple quarters ago that he would see additional 4 cloud titans come to the existing 3 cloud titans in 2027. Any update in relationship to that design activity with the cloud titans, I think, is very, very important. And then if he says anything about that VMware vSphere dominance that they have, I think that's also under the microscope. Yeah,
well, it's interesting now. Our Bloomberg reporters have finally put out their story, and of course, they're framing it around a quote tepid forecast. Yeah, that sounds about right to you.
The law of large numbers are catching up with Avago and NVIDIA, but both are going to benefit immensely from this cycle, not only on the cloud titans, but as we go to sovereign data centers, and then long-term Gen AI private clouds, they're going to be fine.
All right. I really appreciate you taking time for us, Ted, particularly right as the earnings come out. We'll let you get back to it. Ted Mortonson, one of the best in the business. He's managing director and tech strategist with Baird. Shares of Broadcom off the lows in the post-market session, but still down about 2.7%. And this largely seems to be a reaction to their sales guidance, $15.8 billion for the fiscal third quarter. That was slightly above street estimates, but obviously not quite enough. A lot of big movers in the after-hours session here as earnings season winds down, and investors are turning their attention back to the data. And of course, that starts with tomorrow's jobs report. About 16 hours from now, the U.S. government is expected to release that payrolls data for May, and that is expected to be softer than what we had in April, but not as weak as it would have been if those tariffs on China hadn't actually been paused mid-month. Now, for the next rest of this hour, we're really going to dissect the U.S. labor market with a look at consumer spending and the health of the retail sector. We just talked about Broadcom earnings. We're going to take a deeper dive into that and how AI may actually change the employment landscape. We're also going to take a look at that budget bill and its impact on the local economy and a look at the state of entrepreneurship and new business creation as well. But let's start off with retail and the company Tanger, which operates open-air shopping centers across 21 U.S. states. Stephen Yalof is joining us right now. He's the president and CEO of Tanger. Great to see you.
Thanks for having me back.
A lot going on today, but I do want to get to this idea of kind of where we stand right now with kind of the health of the consumer. We've had a lot of retail and apparel earnings over the last couple of days and weeks, and it's kind of a mixed bag. It seems like people are still shopping, maybe not necessarily all shopping for the same things. And I'm wondering, with the types of outlets and the types of open-air shopping centers that you operate, what has traffic been like?
Well, actually, traffic has been better than expected in the months of April and May. And that trend, I think, is going to continue into June. And a lot of it is shopping. Customers are coming in, they're buying. You know, you take a look at some of the biggest brands in our portfolio, and their earnings and they're producing, and it seems like it's a really good news story for them. But, you know, people are coming to our shopping centers for more than just shopping, too. You know, there's better restaurants that we're offering now. We've got movie theaters, people coming to be entertained. So shopping as entertainment is a really important thing, and we sit right there in the middle of that for a lot of the folks that we serve.
I saw you were adding like Shake Shacks or something.
We did.
Some of those, yeah?
Yeah, sure. You know, Shake Shacks, sit-down restaurants, sports bars. We're adding gyms. We're adding
gyms, right,
health and beauty stores, service-oriented stores. So, you know, the outlet shopping experience of many years ago is we've definitely pivoted into other things, just because hard to compete to get the customer off the couch and into our centers, and we want to give them the things they want.
Well, that's what I am curious about. Like, kind of what is kind of the state of just getting people to physical stores or physical shopping centers, if you will. Just yesterday, we were speaking with Mickey Drexler, of course, a legend in the retail space, and we were talking a lot about just the design of stores. You know, do you need more of those experience to get people there? And what's the expectation when they get there? Do you want them to buy, you know, a shirt off the shelf, or do you just want them to maybe, like I said, go to a gym, get a burger or something else?
Well, look, you know, first of all, I worked for Mickey for many years, so I learned a tremendous amount from him, and you know, and so he's, you know, one of the things he said to us very early on was, you know, in order to keep the customer engaged and entertained, is you constantly have to flow new merchandise and newness into your store. You know, I've taken that theme to the outlet shopping center and our open air shopping centers as well. We're constantly looking for new brands. We're looking for new experiences. We're looking for new, you said Shake Shack, we're looking for new restaurants. So it's really important to keep the experience and the variety up so that the consumer keeps on coming back. And when they come, we want them to stay longer. We want them to come more frequently. And obviously they shop more and they spend more when they're there. You know, you were asking about whether or not they're buying goods off the shelf. I think the way the retail ecosystem is working right now is a lot of consumers are using the phone as a window shop, but I think they're coming in and they're executing their purchases.
Are they being real price conscious right now? I know there's been a lot of talk about the impact of tariffs on the supply chain and whether retailers are going to pass those costs onto the consumer directly. And I know a lot of anecdotal evidence that is already taking place.
Well, I think smart consumers are shopping early. You know, and in fact, one of the initiatives that we just started is an early back to school selling season. You know, the biggest selling season of the summer is back to school.
I saw
that's
late
August.
On June 1st.
Well, you know, we started talking about it on June 1st, but regardless, you know, we want to be real thoughtful about the different geographies that we're in. If school's out, we're going to start talking about back to school. So I think it's a really important program for a lot of folks who are worried about whether or not there'll be product on the shelves in the back half of the year. I'm very optimistic that there will be, but if we can get them to come in and shop early, I think that's better for us.
Is that going to end up skewing some of the results that we see from some of these retailers retailers, or does it all kind of balance itself out?
Yeah, I think it balances itself out. If I can get a customer to even come to our shopping centers a little bit earlier in the season, and perhaps they're shopping, but in addition, they're at the restaurants, they're at the movie theater, they're at the gym, they're at the health and wellness stores and physical stores that we have in the center. I think we're doing a really good job.
I am curious just about the labor market, and particularly in the context of retail, the amount of workers needed in that space, whether you are seeing some of your clients actually still hiring. Do they still need to hire, or are they being maybe a little bit more conscious about economic conditions and saying, okay, let's just make do with what we have?
Yeah, look, I think the best brands are always hiring, and they want to have plenty of sales staff on the floor. But retailers are also getting smarter. Handheld POS is really helping retailers have sales help on the floor, but also checkout on the floor.
Yes.
So you don't have to have a checkout person who just stands behind the counter at the till all day. You can have that person out on the floor. And that's when you're selling. And Mickey will tell you this, you're selling when you're on the floor, bringing product to the consumer.
Well, yeah, and I'll tell you, a big bugaboo of mine was like, sometimes you go into stores and the checkout process is so onerous. And I think, why do you make the part where I give you my money
the hardest part
of the experience? And I would think you would make that easy. But it also gets to the idea of we're seeing a lot more automation, if you will. Right. I mean, you certainly see it in the restaurant space with being able to just go to a kiosk, order what you want, and you don't really have to interact with people. I know that helps to save some degree of money, I would think, for the companies themselves. And
it's speed. Yeah. If you can turn more people through one of your stores, and look, some concepts that works great, but in other concepts, having the interaction with a customer service representative, I think works really well too. And that's one of the big differentiators between shopping on your phone at home and coming into a store, is the ability to interact with somebody, have them show you product, have them show you how to merchandise the product, and if you have a really good salesperson in your store, they know how to get a multiple sale. Say, hey, that pair of pants really goes nicely with that shirt. Yeah. And oh, by the way, did you consider this belt? And that's what we like. We're partners with a lot of the brands through our rent contracts with them, and because of that, we're always encouraged to see those multiple sales and as big a sale as we can when the customers come in.
All right, Stephen, I have to leave it there. Always appreciate you coming in.
Sounds great.
Always
Thanks
a great conversation. Stephen Yalof is the president and CEO of Tanger. We should just point out we are still keeping an eye on what's going on with Tesla, that public tit for tat on social media, continuing now with Elon Musk putting out a post on X saying, in his words, Trump tariffs to cause a recession in the second half of the year. A lot more coming up here on the big program, with a focus on the job market and a focus on AI. Aneesh Raman, he's the Chief Economic Opportunity Officer at LinkedIn. He has a lot of thoughts on how AI will impact virtually all of the jobs out there. A conversation with him coming up after the break. This is The Close on Bloomberg. All right, we were just talking about Broadcom and, of course, how that folds into the world of AI, and there is a connection to what's going on in the labor market. A lot of business leaders are beginning to sound the alarm bell on the impact that AI will have on the workforce, and that includes the CEO of Anthropic, who just last month said AI could wipe out half of all entry-level white-collar jobs and potentially spike unemployment to 10 to 20% in the next few years. Now, our next guest actually says that's not actually all that far-fetched. He says AI poses a real threat to a substantial number of the jobs out there. And, well, he should know. He's the Chief Economic Opportunity Officer over at LinkedIn. Aneesh Raman joins us right now here on the big program. All right, Aneesh, a lot of folks saw your op-ed, and I think it struck a nerve with a lot of folks, both those who are for AI and against it. We always talk in these extremes about whether AI is going to be the salvation that takes us to great heights, or the thing that basically just dooms us all to some sort of, Terminator-like apocalypse. I am curious about what we can see in the data about the impact on jobs and whether it really will remove a significant number of jobs that we need in our market.
Yeah, first, thanks for having me. I know we're all looking at the jobs numbers tomorrow, trying to figure out what those job numbers are going to say. I think when you talk about AI's impact on work, it's not going to show up cleanly or clearly in month-to-month reports. It's going to play out over years and largely in jobs changing, not just getting added or lost. I think it is way too early to have an absolute prediction about net employment, because as we know, in every new era for our economy, jobs get created as much as they get disrupted. But we need to start focusing on how jobs are going to change, because that's already happening. I wrote this piece in the New York Times that you called out. about entry-level jobs, that first rung on the career ladder, because they're breaking down a bit. And I think we need to talk about that more. We're seeing this sort of perfect storm between the uncertainty in the macro environment and then the very real disruption we're starting to see from AI taking on more and more of the tasks of entry-level work. We've got to get focused there, both better training workers as they come into the workforce and then up-leveling those jobs that they go into. That's where I think we all got to be focused.
Well, that's what I'm curious about, because there's a lot of people that are trying to draw analogies to what we saw with the internet boom, which of course was supposed to kill a lot of jobs. And it did kill jobs, but it also created more jobs than it killed. It was just in slightly different fields, and that required a shift. And we now know, of course, there are some folks that weren't able to shift, particularly in the manufacturing space. But I wonder if it's just going to be kind of a repeat of that, where certain aspects of our economy will certainly take a hit, but at least in aggregate, we'll make up for that in other areas.
Yeah, and I think right now, the big thing everyone should realize is that every one of our jobs, at every stage of our careers, at every company in every country is going to get affected by how this technology is going to change work. And so we all need to lean into it. And that moment that we're in now is really about the strategies we have as individuals, as companies, as countries to get to better. A lot of what's going to happen is dependent upon what we do right now. As I think about, you mentioned, electricity, internet, these general purpose technologies that have played out since the Industrial Revolution, steam engine, electricity, the internet, now AI. A lot of what I started thinking about early on is this more like electricity or the internet? And the reason I was asking that is electricity definitely changed work. But work for humans was still largely physical labor. We just moved from the farms to the factory. The internet changed work at a deeper level. It brought intellectual labor into the economy, not just physical labor. I think what AI is about to do is change work similar to the internet. And it's going to mean that we're all going to index more on our unique human skills that allow us to imagine, to invent, to innovate, things AI can help us with, but not replicate in terms of our strength as a species. And so we've got to start redesigning systems of education, employment, entrepreneurship. We've got to help new grads and everyone realize you've got to lean into this, learn everything about AI, learn everything about what you're curious about. It's a whole new world.
I'm sorry, Aneesh, though, but is it too late for that? I mean, when we look at how fast AI has sort of crept up on us, and you look at some of the predictions about how it's going to be involved in our life, we're not talking 10, 20 years from now. You have folks talking about, 2-3 years from now.
I am radically pro-human, so no, it is not too late, because every one of us can start to shore up the unique human skills we have in us. Look, there's a great debate about how quickly this is all going to play out in terms of work, 2 years, 20 years. A lot of it comes down to the stories we tell, the ability to push through the fear and anxiety and start using these tools at work. You're seeing a lot of companies stall out in terms of the productivity gains because they don't have the adoption happening, because they don't have the culture change in place. I think we've got time. I think we've got time to get organized around this. I know for sure every individual watching this has a moment right now where they can start to lean into this, but we've got time at a company level, at a country level, across sectors to get organized. We just need to start having these discussions now.
I am curious, and I do want to go back to this idea, and you kind of touched on this in your op-ed, and there's been a few other folks, prominent folks, have also pointed this thing out. This idea of entry-level jobs, which at least right now seem to be the ripest area for AI to supplant. And the idea is that, well, if you don't have an entry-level job for folks, how do they get to that second tier, right? I mean, most of us in our careers, we started out on that bottom rung, and a lot of the lessons that we learned on that bottom rung is what helped us get to the top rung. If that bottom rung isn't there, what is the trajectory to the top, if at all?
Yeah, I think the biggest thing we all have to do is stop seeing jobs as titles. Every job is a set of tasks. And every job, whether you're a new hire or the CEO, there's certain tasks that AI is going to do more and more on its own, certain tasks you're going to do with AI. So you got to be fluent in AI and the tools. And then certain tasks you're going to do more and more uniquely as a human. If you think about entry-level work, the wrong question is it going or is it staying? The right question is, how is it changing? And so we talk about some of this in the op-ed. KPMG, new grads are working on higher level tax assignments because AI is handling the basics. Mm-hmm. A law firm in the UK, early career lawyers are being trained on complex contracts, not just document review. What you're seeing there is that role changing. You've got folks coming in, and we call out some of the educational institutions that are doing this, trained on AI and the tools, and then better jobs that they're coming into. So I really think entry-level work is going to go from kind of the basement to the lobby, or the lobby to the first floor. It's still going to be there, and companies are still going to need young workers to come in more than ever to bring fresh thinking, to help them innovate, and eventually to be the leaders at those companies down the line.
All right, Aneesh, got to leave it there. I love your optimism. Aneesh Raman, Chief Economic Opportunity Officer over at LinkedIn. And one point that he really did hit on is this idea of needing more education, more job training, of course, to get us prepared for maybe what our AI future holds. Now, is that going to come out of Washington? Well, our next guest says President Trump's big, beautiful budget bill could actually make for some big missed opportunities when it comes to the job market. Gregory Morris is the CEO of the New York City Employment and Training Coalition. It's an organization that prepares New Yorkers for the workforce, especially those in marginalized communities. I do want to start with that bill because there's a lot of provisions in there. And granted, I have not read, all 1,000 pages of it. But when you look at some of those provisions, there's been a lot of discussion that some of the federal support that you have for localized job programs or job training, education programs, that those things might be in jeopardy. Is that actually true?
Yes. What we have heard, what we've understood, and just like you, I have not digested every page of this particular bill, but the conversation right now is about how it is that there is going to continue to be meaningful resource available, training dollars and support dollars to the workers that were just referenced, actually. Those workers that are in that one wage category, first step in the industry, how do I get to the next one? Those dollars could be stripped away. And while it is true that this administration is talking about investment in apprenticeship, the reality is you still have to get the pre-apprenticeship. You still have to have the training and support pathways that get you to that next level. Because when you look at the data, low-wage jobs have skyrocketed. Middle-wage jobs have fallen off the map.
Is that, and I assume that's bad, because I know there was a lot of talk about how we had seen the lowest of the low-wage earners actually start to finally get a little bit of a bigger slice of the pie, and I know that was applauded. Yeah. Some of those were programs that obviously predates the current administration. Was that at the expense of the middle class, though?
Well, I think the reality of this is what has happened from point A to point B is the question. And that is some of this related to what's happening with AI or different skills and training, or let's just face it, what is the business community thinking about right now in terms of its investments, in terms of being able to build their workforce up? Mm-hmm. How do we think about career advancement? How do we think about the supports that are in place? Listen, the pandemic ripped the curtain back in every way imaginable in how the workplace works and how it is that we have to ensure that I think our workforce has the skills and resources to be able to grow over the course of time. We're seeing some struggles with that. And I think some of that has to do with the reality of this particular moment where while we talk about the jobs and the number of jobs, and that report will come out tomorrow, we don't talk about the wages.
Okay, well, let's talk about the wages. I mean, wage growth in aggregate has been relatively strong. I know there has been some concern that it has stagnated over the last few jobs reports here. But do you see that stickiness, though, in that? The idea that now that you've seen that increase, we're not going to regress, or are we?
Well, look, if the reality of this state, for New York State in particular, the occupations that have the biggest growth in the last year have all been part of the workforce that tend to be lower wage opportunities, right? And again, that's not to take nothing away from the impact and value and the trajectory that might exist, whether it's healthcare or social assistance. In New York City in particular, the jobs recovery was related to that category. And it's not to say that there aren't lots of different wages in those categories, in those occupations, but the reality is the buildup has been in the lowest wage workforce.
Well, I'm curious what you're hearing from the companies themselves, because at least I know nationally, when we talk about, obviously this big push by the White House to reshore more jobs in manufacturing, building high-tech equipment, the one thing you hear from a lot of CEOs is, that's great, but where are we going to get the workers?
That's right. That's right. And so the reality of our existing business communities thinking right now about how it is that they are going to source their talent is particularly interesting. And the reality is workforce development in this state, in this country, is not something universally supported with a great deal of impact. In other words, when you think about the individuals who've run for office recently, they don't start by saying, I'm trying to think about what the pathway is to help people go from point A to point B in terms of their workforce development or their employment or occupational opportunities. opportunities, that tends not to be the thing that moves us. And I think the business community looks at this moment in time and says, where am I going to find the talent? How am I going to keep the talent? And how's that talent going to stick with me and be a resource that we can count on?
Real quickly, we have an election here in New York City for mayor, a primary election in just a couple of weeks or so, which pretty much decides the mayoral election, given it's a heavily Democratic city. Do you think we will see a significant change in policy based on the outcome of that election?
The focus of the individuals who are running right now has been on things like affordability. It's been a focus on public safety. That's fine. I support, and housing, I think, is probably the third category. Those are all significant investments that have to be made, but I don't hear anyone talking about wages. In fact, at the debate that took place yesterday, I think the word jobs was used once, and there wasn't anything surrounding it. It just was, we have to think about it.
All right, Greg, got to leave it there. Greg Morris of the New York City Employment and Training Coalition. We're going to continue our discussion here about the labor market and take a closer look at entrepreneurship in a second. But we do want to check in on what's been happening in the after-hours trade. A lot of big movers in the after-hours trade, and none bigger right now than Lululemon. The shares down 21%. This after the company cut its full-year profit outlook. A lot of folks came into this earnings report expecting to see a little bit more of a rebound, particularly when it came to that guidance. You see at the bottom of your screen there, that is Goodyear. The shares are unchanged. The company announcing plant closures in its main South African plant. About 900 jobs going to be cut from that, as well as some charges taking. And of course, we're all eyes continue on Tesla. Those shares plunged by double-digit percentages in the cash session, down about 2% here in the post-market. Meanwhile, the potential beneficiaries of this catfight going on in Washington, like EchoStar, like Rocket Lab, they're moving to the upside. This is The Close on Bloomberg. All right, sticking with jobs ahead of tomorrow's big labor market report, we want to talk small business. New business formations, they've been rising, 5.17 million on a trailing 12-month basis. That's according to the latest Census Bureau data. And small business confidence also starting to rebound despite tariff concerns. Our next guest is an entrepreneur who founded his company before the pandemic. He really knows how to weather stormy sentiment out there. More recently, he struck a deal with Costco, a sustainability partnership with SGS, and was featured in a Google ad campaign during this year's Super Bowl. Rod Johnson is the co-founder of Black & Bold. It's specialty beverages. A lot of people know him, of course, for the Black & Bold coffee. Great to see you.
Thank you for having me.
So I don't know why, but I feel like every time I go to a conference or sporting event, I see a Black & Bold coffee cup. Also, you guys are everywhere. And despite the fact you're a relatively new company, you started in 2018, if that's right. So that's not that long.
Right.
How have you managed to sort of penetrate the zeitgeist in such a short period of time?
Yeah, I would attribute a lot of our growth to our social impact mission. When Pernell and I were deciding to get into entrepreneurship, we realized that the coffee industry didn't necessarily serve us holistically. What we wanted to do was make sure that quality was more accessible and inviting. And I think that that's a large part why people rock with our brand versus others, because they know that they're doing good by something that's a part of their daily habits, if you will.
And we should point out, so what, about 5% of your revenue or profits go to social causes?
Yes, we give 5% of our gross profits to organizations that support youth in need. And since 2018, we've been able to generate almost $500,000 to that cause.
Do you think that actually attracts customers? I mean, customers are interested in that? They want to see that?
I think that there's a rise in conscious consumerism where consumers are asking, where is my dollar going? How is this business reinvesting back into our community? And we answer that bell, and you can see the ascension of our brand is, again, a direct reflection of that change in mindset of consumers.
You started this business a couple of years before the pandemic. You mentioned, obviously you had a much more digital focus coming into this. Were you significantly affected by the shutdowns during the pandemic?
Positively, ironic enough, because while the traditional coffee industry was trying to figure out how to exist in this new space, in this digital space, our go-to-market strategy was by way of e-com. So our business model was much more mature online during the pandemic, and ultimately that resulted in us being able to welcome more people into our ecosystem.
We're now in a situation where, at least here in the U.S., there's a lot of talk about the trade war and how that affects the ability to import goods and, for that matter, even export products that we make here. How much of your products, how much of your ingredients are sourced from overseas?
Oh, 100%.
Yeah, exactly, because we don't really grow coffee.
Exactly.
So how are you adjusting? Have you already seen an increase in your costs?
Yeah, it's unfortunate that as a small business, we have to answer those questions and how do we absorb those, that volatility, if you will. And as a result, we are even more intentional about from where we source. We, as of last year, were a top 30 coffee roaster of fair trade coffee. And by way of that, we have been able to pay a premium for coffee. And that premium is then reinvested in what's called a community development fund. Right. So in addition to the fact that we donate a part of our gross proceeds to organizations, that our sourcing practices are also being reinvested back into those communities as well.
Has your sourcing been disrupted, though, in terms of the timing of being able to get what you want or when you order it?
Slightly, but not significantly. Fortunate for us, we have contracts, longstanding contracts with our importers, and to that point, we haven't felt to this point that disruption. But we are always looking ahead and making sure that we have a plan B in case that happens.
If you do see a material increase in your costs, do you have the ability to pass that on to your consumer? Are they willing to take that?
That's a great question. Yeah. Our job as a social enterprise is to make sure that we're thinking about the supply chain holistically, and our first inclination is to make sure that we are thinking of our customers and making sure that we're not pricing ourselves out of the market, if you will. Time will tell essentially how we will determine that. But
I mean, so a bag of your coffee? I mean, what am I going to pay for that at the retail level right now?
It depends. Yeah. The MSRP on our coffee, it ranges anywhere between $14.99 and $16.99.
So that's relatively competitive with what you see with a lot of other sort of higher quality mass market brands here. Is the idea, though, that the consumer that would buy that can afford to buy that, if for some reason you had to bump that up by $1 or $2, would they leave, do you think?
I don't think so, because we stand for much more than the product. Because we are intentional about where we redistribute our proceeds, I believe that is what attracts folks to us, regardless of what's happening with macroeconomics. They know that we are a purpose-driven business, that we are actually reinvesting back into our communities, and despite that volatility, I don't anticipate that we'll see any melt-off.
How many employees do you have now?
25 employees.
Are you planning to hire?
Yes, we are expanding because our business is growing, and we want to make sure that we have key personnel in particular areas to help us sustain the growth. Our business model has since expanded beyond e-com, and as we show up in more away from home locations, having the right personnel to guardian that is going to be paramount.
You're also based in Des Moines, Iowa, which when I think of a startup company, I think of a coffee importer, I would not think of Des Moines. I'm very familiar with Iowa, having spent some of my childhood there. Why Iowa?
I have my business partner to blame for that, but to that point, there isn't much competition as being entrepreneurs or in the coffee industry. So I would say being in Des Moines has actually served as a benefit for launching our business in such a competitive industry.
What's the environment like there, the business environment out there in Des Moines? I know you have some big companies out, a couple big financial companies, including one that sponsors this show, we should point out. But there are some big players out there. I am just curious. I mean, it's been years since I've set foot in Des Moines, but I'm just curious what the environment is like right
there are a lot of headquarters there. So you think about Meredith, you think about Principal Financial, and a few other large conglomerates like that. And then there's a lot of focus on agriculture and insurance. I would say Des Moines has a variety of industries represented, despite what the narrative may be about there. And we're doing our part to let people know what can exist, what can grow, what can be successful, regardless of your location.
All right. Well, Rod, this is real fascinating. I'd love to get you back in a while to see what type of progress you and Purnell are making. Rod Johnson there is the co-founder of the specialty coffee company Black and Bold. All right, stick with us. We're going to be back in just a second. This is Bloomberg. And as we close out the close here on this Thursday afternoon to push ahead to what folks will have their eyes on, and the first big thing, of course, is the NBA Finals. The 79th title series kicks off tonight with the Oklahoma City Thunder hosting the Indiana Pacers. That starts at 8:30 p.m. Eastern Time. Meanwhile, back to financial markets and 8:30 a.m. Eastern Time tomorrow. We are going to get that jobs report from May, the official government data. We're expecting to see a change in non-farm payrolls, 125,000 jobs added in the month. That would be a deceleration from the 177,000 added back in April. We should point out the unemployment rate is expected to hold at about 4.2%, and the labor force participation rate expected to hold at about 62.6. We're also going to get an update on consumer credit, and this could be interesting because, of course, we had seen a lot of movement in that space as consumers were starting to become a little bit more reliant on their credit cards. That data drops at 3 p.m. Eastern Time. That does it for me on the close. I will be back tomorrow, but stick around. A lot going on in Washington. Kaylee Lyons and Joe Matthew, they're coming up at the top of the hour with Balance of Power to talk about you know what.